Chapter 10, Investor Psychology. Section 1, Emotional Biases. Emotional biases happen when investment decisions are driven more by feelings than by analysis, especially when the urge to act feels stronger than the discipline to follow a long-term plan. Fear, hope, pride, regret, and excitement can all create a powerful pull to sell, chase returns, or do something now, even when the facts suggest a different choice. That does not mean an investor lacks intelligence. It means markets often trigger very human reactions to losses, uncertainty, missed opportunities, and comparison with others. It helps to separate mistakes in thinking from decisions driven by emotion, even though the two often overlap. Cognitive biases come from faulty reasoning, so better data, training, and careful analysis can often correct them. Emotional biases are different because fear or excitement can keep pushing an investor toward a choice even when the facts clearly suggest otherwise. Investors make decisions in an environment filled with sharp price moves, constant headlines, and other people reacting in real time, so it's easy for emotion to take over. Losses can spark fear and regret, rallies can stir excitement or envy, and uncertainty often creates pressure to act fast. Add social pressure from the crowd, and disciplined investing can feel much harder than it sounds. Loss aversion is the tendency for a loss to feel more painful than an equal gain feels rewarding, and that emotional imbalance can push investors off course. It often shows up as selling winners too soon, holding losing investments too long, becoming overly conservative after a decline, or avoiding rebalancing because selling feels uncomfortable. The real risk is not simply disliking losses, but letting the desire to reduce short-term pain override a sound long-term process. Overconfidence is when a few winning trades make you believe your skill is higher than it really is, often because luck gets mistaken for skill. That can lead investors to trade too often, take positions that are too large, underestimate how much they could lose, and ignore diversification. The key protection is a disciplined process, because short-term success does not mean you can reliably predict the market. Loss aversion and overconfidence get a lot of attention, but other emotions also shape investor behavior. Regret aversion can make people freeze because changing course might feel worse if it turns out to be wrong, and hurting feels safer because being wrong with a crowd is often less painful than being wrong alone. Fear often pushes selling after markets have already fallen, while greed and social pressure can pull people into buying after prices have already surged. Emotional bias often follows a loop. A market move triggers fear or excitement. Fast thinking creates a sense of urgency, and that pressure leads to a quick decision. The tricky part is reinforcement. If that reactive move happens to work once by luck, it can feel like proof the process was sound. Recognizing that pattern makes it easier to pause and interrupt a weak habit before it repeats. An investor buys ARK at 80, watches it drop, and sells at 55 mainly to stop the stress of further losses. Even if the fund later recovers toward 75, the lesson is not that holding would always have been right. The real issue is that fear and loss aversion took over, replacing a disciplined review of the original thesis, risk tolerance, valuation, and rebalance rules. A quick gain can make an investor feel unusually skilled, even when nothing about their process has improved. In this example, buying TSLA at 250 and watching it rise to 350 leads to a bigger bet. So when it later falls to 280, the larger position causes more damage. That is how confidence after gains, just like fear after losses, can push people into the classic mistake of buying high and selling low. Emotional biases never disappear completely, but you can manage them by creating habits that slow your reaction and bring you back to a plan. A written investment plan should spell out your asset allocation, rebalancing rules, and when you would buy or sell. Then any action can be checked against your risk tolerance and viewed from the perspective of a neutral observer. After major market swings, take time to review what you felt and did, because those moments often reveal emotional triggers that are only obvious in hindsight. Many expensive investing mistakes come from emotion taking control, like selling after a drop out of fear, chasing a rally out of greed, trading too much after a win, or refusing to exit a loser out of pride. Even risk tools can backfire when stop losses are set too tightly in a volatile market and trigger needless exits. The goal is not perfect prediction or emotion-free investing, but building rules and habits that keep decisions aligned with a steady long-term plan.